I think we had a very interesting conversation this morning about the state of the secondary market, and I wanted to really add to what John Wade was asking. His question was that the interest rates have been going up, and he did not expect the premiums to go up. That was really his comment. And I was sitting and listening to his conversation, and I thought to myself as to what could be causing that. And I have a hypothesis. And the hypothesis is that the impact of the rate increases have been in many ways negated by two factors. One is a weak dollar, and the second thing is factors in the economic environment that are keeping the yields low at the long end of the bond. And there are two themes that have dominated the secondary market in the last year. One is, of course, the 7A and all the issues with respect to distributions and prepayments going up recently. And the second is really the elephant in the room, which is the flattening of the yield curve. Now, 1 year ago, the 2-year Treasury was roughly 75 basis points. Today, it's 175. And if you look at the 10-year Treasury of a year ago, it was around 235, something like that. And it is still hovering around 235, it's 238 this morning. So something is happening in the marketplace where the long end of the bond is staying the same. There are factors that are holding back, the long end of the bond, whereas the short end, is steadily climbing. And so, you have a flattening of the curve. This 2-year and the 10-year differential has gone down from 175 bips to 160 bips, I guess, to about 60 bips. It's gone down by over 100 basis points in 1 year. In the last 2 months, it's gone down by 20 basis points. So what is causing, the short end of the curve to go up and the long end to stay stable? I'm just going to take 2 minutes to talk about that. And that, recently, of course, Powell is nominated for the Fed, and he has, made a statement that he's going to gradually increase rates. But the Fed also came out and made a categorical statement that they're going to address any borrowing needs in the country by short-term debt and not long-term debt. Now just think about it. If you are in the market and you buy short-term bonds, and the Fed is telling you that they're going to increase the rates, you know for sure that if you buy those bonds, the value of that is going to go down as soon as the rates go up. And that is the reason why, there's a depression, in the demand for those bonds, unless, of course, you increase the yield. You make it a little worthwhile for the market to buy those bonds. And that's what is happening. The short end of the curve, is going up because of the Fed announcement. Okay. The second interesting thing, if you think about it, the weighted average maturity of all the outstanding debt in the United States is about 70 months. Okay. And where are you seeing the rates go up? You're seeing the rates go up in all the segments up to 70 months. There are some banks, in this room that are really, working the system well by, trying to look at 7-year fixed or higher. So if you are doing, or making loans that are in a 5-year fixed or less than 70 months, which is the weighted average maturity, you're getting impacted on the premiums. Not so much, if you go to the higher end, if you go beyond, the 7-year segment. So that is the thing. Now, what is impacting the long end? We understand the short end is because, the Fed wants to borrow short, At the long end, everything around us is impacting, the long end. To take an example, the 10-year Treasury rates and the 10-year German bonds, the differential is over 2%. It has never been about 2% for the last 30 years. America is feeling the effects of German gravity, that's one. The investors who are in Japan and Europe, they get negative interest rates for keeping money in cash or in short-term bonds. So all those investors are creating a demand for US Treasuries, so they're buying it. That's depressing the yield at the long end. So you have that. And, you always have conversations, you hear in the news about Manafort getting indicted. So immediately the market draws the conclusion that there's going to be a legislative stalemate or slowdown in the bond issuances or slowdown in the agenda that the administration has. And the yields fall immediately for 5 bips, you see. Every time there's a conversation that the tax bill is through or infrastructure spending is going to come, market concludes that there's going to be more bond issuances, and therefore the yields are going to go up. So you've got a variety of factors. Everything happening around us has an impact on that. Of course, inflation is very, very low, and so that's a very important factor as to why the long end is where it is. So I just wanted to share a few thoughts on what's happening with the flattening of the yield curve, because that is the most dominant theme that you have besides everything happening in the 7A market. So I thought I'd just share a few ideas. That's it. Thank you.